Hi, and thanks for joining us today. My name is Andrew Grant, and I'm the Director of Manager Research and Investment Solutions here at Kayne Anderson Rudnick Wealth Advisors. And joined with me today are two senior wealth advisors, Tom Connaghan and Brian Chang. With the markets hitting all-time highs continuously this year, and really since 2009, we've seen an absolutely amazing run with a few hiccups along the way. Today, we wanted to have a discussion with you all about concentrated positions. It's a topic of conversation that's been coming up much more with investors that we're talking to. So today, we wanted to run through an agenda with you that will cover areas like how do concentrated portfolios work in clients' current portfolios, using a planning first framework as to how can we help them with those concentrated positions. We'll go through some of the key questions that we typically ask investors as to how do they feel about those concentrated positions. And we'll talk about potential solutions, trade-offs, and really what differentiates our approach here at Kayne Anderson Rudnick Wealth Advisors when helping investors around the concentrated stock solutions. So recognizing first that not every investor that does come to us or talks to us about a concentrated position needs a solution, but we'll dive into that a little bit later. And we'll get started and we'll turn our attention first here to Tom. Tom, I think what's really on investors' minds here as it pertains to concentrated solutions is what are the typical discussions that you're having with clients? What is the feedback that you get from them? And what are they coming to you for as it relates to concentrated positions? Can we have you start there?
Sure. Thanks, Andrew. Sure. In the heart of Silicon Valley here, there's no shortage of portfolios and balance sheets that we see with concentrated positions. And it can be one or it could be a handful of companies. These are important decisions. Obviously, we can't predict the future for individual stock positions. And we see these positions get into portfolios through current or past employers. Maybe they're inherited, or maybe they were purchased long ago and have appreciated significantly. So as a fiduciary and trusted advisor, our strategies and solutions are designed to work with investors to figure out how best to achieve their financial goals. There is not a one-size-fits-all solution. And so often we're providing some context to current positions and then going through a bunch of questions to get at how best to tackle these issues. This slide here speaks to the risk and opportunities for any given position. The reality of a single stock risk scenario is quite real. Since 1990, 25% or a quarter of the companies in the S&P 500 went down by at least 50% and remained below that level. That's obviously going to impair a portfolio and potentially affect an investor's financial goals. The second part is owning a handful of positions or an individual position obviously would have more volatility than owning an index or a basket of securities. So those are some data points that help set the framework for why these discussions are coming up more and more. Andrew, if you turn to the next slide, I think this is also interesting, and then there are lots of different ways to look at the context of concentrated positions. Since 1985, this slide is simply showing that the top 10 companies in the S&P 500 by market cap have changed throughout the years. And one of the takeaways is there really isn't one single position that has remained for multiple decades through this chart here at the top. And so, analyzing and keeping track and monitoring positions is very important. As we look at 2025, there's a whole new host of companies that not only are in the top 10, but are significantly larger as a percent of the S&P 500 in general.
Tom, I love this chart, right? It really paints a great picture of why concentration or having one or two stocks, there are risks involved, right? And again, if we're starting to get at the questions that people come to us with, right, and it goes through a host of what are your goals, what are your objectives, what keeps you up at night. Brian, from some of your discussions that you're having with investors, what are you seeing? And, let's maybe get into some of the risks, I think, that pose a challenge for people, knowing that they've made a ton of wealth by owning one or two or three of these stocks that we hear very often in the news today.
You brought up a great point, Andrew, that having a concentrated position is a great way to build wealth, but not to preserve wealth. One of the most common questions I receive as an advisor is, how much concentration is too much concentration? And there really is no one-size-fits-all answer to that question. I always like to bring it back to their financial plan, talk about their financial goals, talk about their investment preference, and talk about their risk tolerance. Do we have a path where we can exclude that concentration in their portfolios and still get to where they need to be in achieving their financial goals? If so, maybe that client can take on more concentration. If not, we should look at ways to reduce that concentration. And when it comes to risk, we've seen a lot of successful stocks over the years. It started from FANG, then evolved into FANGMAN. Now we have the Mag 7, and they all pose different risks at different times. In 2022, with the mass sell-off due to inflation, due to rate hikes, a lot of these successful names had significant drawdowns. Even as recent as 2026, with the isolated risk within software, we're seeing individual names getting picked off one at a time. A common objection I receive is, oh, these stocks always come back. Oh, it's a great buying opportunity. We can separate that and focus on the financial plan, which is what we always want to do. Sure, they can come back, but how much should we reduce to ensure that each and every one of our clients have a successful plan?
Right. It's so hard because the what percentage of my portfolio should I keep in concentrated stocks, I think, is one we hear so often. And we don't typically have, the perfect answer, because again, it depends on a whole host of other questions. What keeps you up at night? How would you feel if we're looking at this chart? How would you feel if this position was down 75%? We know what's happened to them since, that they can come back, but it creates an emotional and a behavioral response. And what were people doing at the end of 2022? We want to take that off of their shoulders. We want to help them understand, how can you diversify, or how can you keep this concentrated position, but how can we put some risk, parameters around it, or ways to buffer you from a downside, right? So I think what's great right now, and again, looking at this chart, we saw a little bit of a redux here in 2006. But if we're talking about what the roadblocks are, Brian, what are the pushbacks that you typically see when you start talking about how we can help someone exit from a concentrated position? What is that usually?
So there's several pushbacks, right? It depends on how they receive the stock, how much gains are in that particular stock. For an example, some clients received the stock from a legacy point of view. They were passed down these assets. It means something to them and to the family. They don't want to sell. Other clients have a very positive outlook on a particular company and don't want to miss out on gains. Certain clients are concerned about taxes. They have very low cost bases, and getting rid of that position in any manner means a significant tax bill. So it's a combination of sentimental value, fear, greed, loss of opportunity, upfront cost in getting out. And part of my job is really get down to the core of that emotional feeling and finding a solution that balances their emotional well-being along with their financial well-being at the same time.
Yep, such a behavioral characteristic here. Tom, do you have anything to add there?
Yeah, sure. I would certainly echo that an emotional tie to a position is something that we discuss quite a bit with investors. Sometimes investors are anchored on a certain price that they're looking to get back to rather than sell over the course of weeks, months, or years. We often find that investors that are working for a current employer may feel stronger about the market outlook for that particular position, but if they leave or retire, they become less confident in the ability of the company, and that may affect their plan with the concentrated position. And then with our significant research capabilities at Kayne Anderson Rudnick, we often can provide some objective view on how the company has performed. How is the stock actually done? What are the benefits and what are the other opportunities? Because there can be a bias that the company has done better than most, when reality maybe points to some different performance. So those are the key things that we're looking at.
It's a big differentiator when we're able to have this sort of investment management DNA and look at it from that perspective. So I think that's extremely helpful. And turning to what are some of the solutions here that people can go through, Tom, we'll stick with you here on,
Sure.
on the types of solutions that you're seeing that work the best or clients are responding to with the most enthusiasm, that make the most sense for them in their financial plan. Can you go through a couple of those for us, please?
Sure. Yeah, I think it's important to note, as Brian pointed out, that financial planning and estate planning are a key component of this analysis as we're having these discussions with folks. And additionally, there are multiple strategies that we're utilizing to kind of tackle this issue. Again, one of them is to just hold on to some long positions and let them continue to do what they do. Here on the left are a variety of different options. The direct indexing and long short solutions. Direct indexing provides diversification. It takes advantage of tax loss harvesting. You're often looking to reduce the volatility of an individual position or multiple positions more in line with an index, and it can be very helpful for whittling down that position. The long short, which is a very similar approach, is a relatively new solution for investors over the last few years, and it's similar to direct indexing, but utilizes some long short extensions, as the names would imply. So you can more aggressively harvest losses and perhaps bring down a concentrated position while also looking to achieve the objective of outperforming a given index. Exchange fund, as the name implies, is exchanging a position or a concentrated basket of securities instantly on day one for diversification, and over time separating or allocating that unrealized gain portion across a basket of securities. So I think one item that we may not have listed here also that comes into play is dollar cost averaging out of a position, structurally setting times, again, weeks, months, years, so that you are paring down positions over time to leg out of them. Brian, why don't you speak to a few of the other strategies that we utilize in speaking with investors?
Thank you, Tom. One of the key items that you mentioned earlier is that certain clients have a set target price before they are willing to sell a stock. And that is very valuable insight that we can use during our planning process. Retirees that need income can set that target value and generate income using covered calls. At the same time, we're never selling the stock so that they can continue to hold on to that position. Other clients that have a more flat to negative outlook, what we can do is we can protect that position with different levels of customized protection. Certain clients just want exposure to a broad-based index. Then we can really narrow down our protection on the concentrated stock and replicate a benchmark exposure such as the S&P. These are all conversations that we will recommend, really based around the planning and the investment preference of each client. I would also like to add on to that, there are clients that are more charitably inclined, and strategies such as donating to a donor-advised fund can reap benefits from an after-tax perspective. Other strategies such as donating to a charitable remainder trust can create a stream of income to the household and also diversify at the same time, and finally meet their charitable giving needs at the end of a customized term. Other clients who are more focused on legacy can look at complex trust strategies to pass the asset down in the more tax efficient way, saving on estate tax or saving on appreciation as well.
Those, I think, thank you both for hitting on those solutions. And I think what I have seen is not every investor fits into one of these solutions perfectly, right? Again, you have to go through the conversation, you have to go through the planning. We have clients that have multiple solutions for one concentrated stock that they own in their portfolio. So again, this is highly customized, and it's all dependent on pulling out from each individual investor what is most important to them, what keeps them up at night, right? So a lot of solutions for people with the understanding, and we know that there is a decision framework here, right? Or a decision tree that we typically go through with people. Brian, sticking with you, can you walk us through decision trees, right? How you might get to a solution, one or two basic examples, please.
Very early on, during even the kick the tire process of our conversation, we'll try to go through each of these areas where we talk about what is your outlook on the stock? What is your risk tolerance? What happens if the stock falls 20, 25, 30, or even cut in half? How would that impact you from an emotional perspective? How would you feel during those moments? From there, it's about addressing their financial goals. What type of income do you have? How do you fulfill your living expenses with the asset makeup that you have today? Then from there, should we hold on to a portion of your stock because you have a very positive outlook? And if so, how much without disrupting your sleep at night or even your financial goals? And then at the same time, once we have the concentration that remains and the income need addressed, we can have an outlook into how much assets they'll have 10, 20, 30 years down the road. Then we can have the more complex questions surrounding, do we want to have any charitable giving built into the plan? Or do we have any estate issues where we can build complex estate strategies around saving on estate tax? It's more of a conversation for me than a check the box decision framework.
Yeah.
We really trying to dig in and understand how each individual household are as investors before we come back with solutions or just one solution.
Tom, anything you would add there just on the decision tree that you typically go through?
Yeah, I think what's interesting about this decision tree, and there are a lot of details here, but the solutions are varied. Using our estate planning group is an incredibly important component of this decision process. I would also add that often the positions that are being looked at with investors, they may overlap with some of the proprietary strategies that Kayne Anderson Rudnick invests in. So not that we're advising always on individual positions for clients, but we do have a significant research background that can help guide this process, or at least the decision on how much to hold and how to approach using an individual position in a portfolio across these different options and strategies.
Yep. Yeah. And like you both have said, and I have said as well, and I'll reiterate some of these items here, is it's about having a plan, right? It's about allowing yourself to be fluid, really dig in with the client, understand what their concerns are. I will also reiterate that not every client that has a concentrated position is in need of a solution. So we very much understand that. This typically comes about as the investor asking us what to do with that position. And we have multiple solutions. And a client or an investor could have multiple concerns where that's where multiple solutions take place. So if you do have a concentrated position, if it's something that is creating concern for you in your portfolio, If you're wondering about diversification, if you want to have a conversation with an advisor, I think these are all great topics. And Brian and Tom, really appreciate you two taking some time today to walk us through what people are facing from a concentrated risk standpoint, what those solutions are and what the questions are that you ask them. So to our audience, thank you very much for joining us today. If you have any questions, please don't hesitate to reach out and contact us. We'd be more than happy to have a conversation with you. And we thank you for joining us.
Thank you.